A quick revision of the topic of cash flow statement. As the name itself says, cash flow statement is a statement. This is a statement which is financial statement. Section 2 subsection 40 definition as well as section 129 of Companies Act covers this cash flow statement. And this is a statement which is prepared to analyze cash flow. We can say that cash book also does the same thing, but cash book analyzes the cash flows into only inflow outflow. Here, each inflow and each outflow is further analyzed into three major activities, that is financing activity, investing activity and operating activity. Any business to originate, first you will get the idea, then you will raise the money, you will use that money and set up the infrastructure, and then you do operations. Same is what we are trying to analyze here. When you raise the funds by way of issue of equity shares, issue of preference shares, issue of debentures, raise of loan, it's all financing inflow. Using that you set up infrastructure, buy assets, that is investing outflow. And later you start your business, buy goods, convert the goods to work, finished goods, and then pay expenses, sell the goods, do the business. That's operating activities. And once you get the profit, using that profit, you pay interest, you pay dividend, that's financing outflow. You're done with the business, now you want to stop your business, you sell your assets, investing inflow. And using that you repay debt, financing outflow. You repay debenture holders, financing outflow. You redeem preference shares, you buy back equity shares, you basically close down the business, that is financing outflow. So do you understand how we're trying to analyze the flow of cash in and out into each of the activities? By having a look at these activities, we can understand the pulse of the organization. If too much of investing outflows are there, then the organization is growing. If investing inflows are more, the organization is selling its assets, it's basically closing down its operations. Huge financing inflows means they're borrowing more and more money, they're raising more and more capital. Repayment of debt and buyback of shares, redemption of shares, all of this will lead to financing outflow. That means organization is shutting down. To an extent it's fine, repayment, but beyond a point, if you're buying back shares and if you're paying back loans, that means the organization is basically closing. And positive cash flows from operating activity tells the profitability of the organization, how rich is the organization when it comes to cash. And this is one of the metrics using which we can scale, we can understand the scalability of the organization as well as the operations and functions of an organization. You get it? Very good. And when we use the word cash and cash equivalent, in this context, the word cash and cash equivalent is very different from what we basically use under the context of Schedule 3. Under Schedule 3, when we say cash and cash equivalent, it includes fixed deposits which is made for a period longer than a year also. And it will never include the context of investments. However, cash and cash equivalent as per AS3 means cash is cash in hand and demand deposits with bank. Demand deposits is savings bank deposit and current account deposit. However, when we say cash equivalent, it includes investments which fulfill four conditions. RISH, readily convertible, insignificant risk, short term and highly liquid. When I say insignificant risk here, it means it should be listed securities or it should be government bonds or of that sort. When you say short term, we refer to the period of 3 months. If it is lesser than 3 months investment, then it is cash equivalent. If it is even fixed deposit for a period longer than 3 months, it will not be cash equivalent as per AS3. However, as per Schedule 3, it will still be cash equivalent. So the definition of cash equivalent as per AS3 and Schedule 3 are different. It will not match. Please be cautious about this part. And once we talk about this cash flow, whenever we pay dividend, dividend is paid against the shares that we issued, that will be financing activity. However, dividend received will be usually investing activity because you have invested in the shares of the company and we're receiving dividend out of it. However, whenever we receive dividend, because we are an investment company, our only objective is not to produce a product or give service. Buy the shares, sell the shares, hold it till dividend, and then once we receive dividend, we sell. This is our business. In such a case, dividend received will be operating activity. Similarly, interest paid is financing activity, interest received is investing activity. However, if we are a financial enterprise wherein we don't have a product, we don't have service to give, our only objective is to run our own money, raising the money at lower interest, lending the money at higher interest. So we are money lending business. Our business is a financial enterprise. Then borrowing and lending of money, or it is operational activity, paying interest and receiving interest will become operational activity. Got this? Then I told you the cash flow statement can be prepared in two formats, two methods. One is direct method, other one is indirect method. What is recommended by AS3 is actually indirect method. What we should prepare prominently in a practical scenario is actually indirect method. If you analyze a cash book, debit side there will be opening balance, credit side there will be closing balance. Receipts on the debit, payments on the credit. Opening, closing, I'll keep it aside. Opening here, closing here. Rest of the receipts and outflows, receipts and payments, I'll cut them into three parts. Operating, investing, financing. Operating receipts, operating payments. Together, it will lead to cash flow from operating activities. And investing inflows, investing outflows, investing receipts, investing payments. Together, net cash flow from investing activities. Financing inflows, financing outflows, financing receipts, financing payments. Together, net cash flow from financing activities. So we have operating cash flows, investing cash flows, financing cash flows, opening cash and cash equivalent to arrive at closing cash and cash equivalent. This is cash flow statement. Under which method? Direct method. Under indirect, it looks very much the same. Only difference is operating is found differently. If you closely observe the financial statements of an entity, balance sheet liability side represents financing activities. Balance sheet asset side represents investing activity. P&L account represents all operational activities. And even further analysis tells us that all the incomes that we have are actually inflows of cash, all the expenses are actually outflows of cash. Income minus expense is profit. Can I say income minus expense profit is inflow minus outflow, net flow from operational activities? We cannot promise that it is cash outflow or cash flow from operational activities, but it is very close. Net profit is a very close item to cash flow from operating activities. It will become cash flow from operating activities if we eliminate few non-cash items or non-operating items that is there in our P&L. So what do? We'll start with net profit as per P&L account after tax. To this, we add back non-cash or non-operating expenses which were previously debited in P&L, like interest charges, like depreciation, amortization. All of these are non-cash or non-operating expense debited to P&L. Because of this, profit has decreased. If I remove the impact of this, my profit will increase to become cash profit. Similarly, there are certain incomes which are non-cash and non-operating but are credited in P&L. For example, dividend received, interest received, profit on sale of assets. So these are non-cash and non-operating, or non-cash or non-operating. These non-cash and non-operating incomes which were previously credited in P&L have increased our profit. Now if I eliminate that, my profit will decrease to become cash profit. So what I would do, I would take my net profit as per P&L account. To this, I'll adjust non-cash and non-operating items. How do I do it? I add back non-cash or non-operating items debited to P&L. I deduct non-cash or non-operating incomes credited to P&L. Once I do this, I won't get cash flow from operating activities. I'll get operating cash profit. The reason why it is not cash flow from operating activities is certain items in the balance sheet liability side and balance sheet asset side actually represent operations. For example, current liabilities and current assets. We cannot look into each current asset and current liability in detail and check how much cash flows have happened. But we can write the net difference. How do we do that? We write changes in working capital. For a current asset, we do opening minus closing and then write it. For current liability, we'll do closing minus opening and write it. The reason is, whenever there is increase in current asset, it means current asset is been purchased by paying cash. So we do opening minus closing. For a current liability, whenever there is increase, it means we have repaid the loan. So cash and cash equivalent should decrease. Whenever there is increase in current liability, that means you have borrowed the money, because of which cash and cash equivalent should increase. So what do? We take net profit as per P&L account. We adjust non-cash and non-operating items by adding non-cash or non-operating expense debited to P&L, by deducting non-cash or non-operating income credited to P&L. To this, we adjust changes in working capital. How do we do that? We add, we add current assets minus current liabilities, and we deduct current liabilities minus current assets. For current assets, we do opening minus closing. For current liabilities, we'll do closing minus opening. See, current assets we do opening minus closing. Current liabilities will do closing minus opening. Once we do that, we get cash flow from operating activities before tax and extraordinary items. We deduct the tax paid and then we get cash flow after tax. If there is any extraordinary but operational items, they will be written here separately. This is before and that is after. That is to be disclosed separately. What we refer to as extraordinary items under AS 5. I hope you guys understood this. Very good. And whenever I say working capital changes here, there are 3 items which should not be included in this working capital. Item number 1, provision for tax. Item number 2, proposed dividend. Item number 3, cash and cash equivalent. I repeat, proposed dividend, provision for tax and cash and cash equivalent. These 3 items should not be included within that. The reason, proposed dividend, last year's dividend is paid this year's dividend is paid next year. So don't treat it like a current liability. Open ledger, right? Opening balance of liability on the credit, closing balance on the debit. Dividend declared further will be written on the credit. Paid during the year will be found as balancing figure. Same with regard to tax. Tax provision is a liability, opening balance on the credit, closing balance on the debit. Further tax provision created during the year will be credited in provision for tax account. We identify tax paid as balance and figure in the debit side. This is the reason why we prepare ledger account. Tax provision created during the year is a non-cash expense debited to P&L. So it will be added back in cash flow from operating activities under indirect method. Dividend we don't add back. Reason is dividend is appropriation item. It will not be debited to P&L, so we don't add back. We add back items because it was previously debited and it has decreased our profit. Dividend is never debited to P&L. It has not decreased our profit, so we don't add it back. But provision for tax has been deducted from the profit to find net profit as per P&L, which is our starting point. So we add back. I hope you guys got this. Cash and cash equivalent will not go into adjust it in changes in working capital because that is the reason now we prepare entire CFS. And in the question, if they've given straight away adjustments, depreciation, amortization, profit on sale of asset, it's very easy. Start with PL, add or less these items, do changes in working capital, pay tax, cash flow from operating activities. However, certain questions they don't do that. They give you PL, they give you balance sheet. In that case, open ledger account for every item with difference in opening and closing balance, or item with same opening closing balance but as adjustment. You get this? But for 3 items, you don't open ledger: current assets, current liabilities, and cash equivalent. But among current asset, current liabilities, you will still open ledger for provision for tax and proposed dividend. In each of this ledger, identify 2 things: 1, P&L, 2, cash. If it affects cash, categorize operating, investing, financing, check inflow, outflow, write it to cash flow statement. If it comes to be P&L account there, profit on sale of asset, loss on sale of asset, premium on redemption of debentures, premium on redemption of preference shares, or interest received, interest paid, expense paid, some item. All of these items might be non-operating or non-cash items debited to PL, or non-operating or non-cash items credited to PL. If it is non-operating or non-cash items debited to P&L, add back. If it is non-operating or non-cash incomes credited to P&L, deducted. And that's how we close our cash flow statement. Last point that I want you all to remember: whenever you're doing cash flow statement, always keep in mind double entry system and then prepare it in the order, and your cash flow statement is sure to tally.